Hello, welcome to the Accounting 2 final exam review. I had someone ask for some kind of review for this final exam, so this will be probably 15 minutes, maybe a little bit shorter. What I did is I went through the exam question by question, categorized the questions, and then made a slide for each one. So nothing fancy, but I will answer 95% of the questions in this lecture. So you might want to watch it once or twice, take some notes, whatever, so that you're prepared for the exam. The exam is 50 multiple choice questions, and it does cover some things from Accounting 1 as well as Accounting 2. So there's going to be some questions on classifying accounts as assets or liabilities, giving normal balances, things like that from Accounting 1. There will be some adjustments and things like that. So it's not that you have to go back and study Accounting 1 really hard, but there are some concepts there that will be tested. So in our class, week 1, there was a review spreadsheet, so I would definitely go through that just to make sure that you're reviewing what you need to in Accounting 1. So let's start. The first topic is sales. And to get net sales, we want to take sales minus discounts minus returns and allowances, and that is going to give us net sales. So sales on the income statement, a lot of times, as you've seen in your research projects, it'll just say sales or net sales or something. So companies don't report discounts and returns and allowances, but no, in their books they do have to keep track of that. So I always say, think of Kohl's, probably 50% of what they sell is returned. So they need to have a sales figure that shows what their actual sales were, not what returns and discounts and things were. So another hint, when you see the word net, that means 2 or more numbers are going to be subtracted. So think net income, net sales, you're always subtracting. Journal entries with respect to sales, debit AR, credit sales for sales on account, and then instead of flip-flopping that when there's a return, we're going to debit sales returns and allowances and credit, I'm sorry, not sales, but AR, to get rid of the AR. So that sales returns and allowances account is a contra sales account, and it has a debit balance, whereas the sales account, right, has a credit balance. All right, next topic is accounts receivable. And there are some questions dealing with the allowance method for accounts receivable, the allowance for doubtful accounts, the bad debt expense. And remember, we offer accounts receivable, we offer credit so that we get more customers, more sales. But not all of them are going to be collectible. Some people will default. We don't know who they are, so we have to estimate the amount of the default, and that's called bad debt expense. There's 2 methods to calculate bad debt expense in the allowance method. One is the percent of sales method, one is the percent of receivables method. The percent of sales method, you take your percentage, multiply it by your credit sales, and that equals your bad debt expense. In the percent of receivables method, you're going to take a percent times your accounts receivable balance. That's going to give you the ending allowance balance. And remember, you have the allowance for doubtful accounts, which is a contra asset account. And you have to take that ending allowance balance and subtract the beginning balance to get the bad debt expense. So you have to do a little bit more calculation to get the bad debt expense in the percent of receivables. You'll have to do both of these methods on the exam. So read the question carefully so that you know exactly what they're asking. Then we go to notes payable. If we have a $1,000 10% 3-month note payable issued on November 1st, at issuance, cash and notes payable. Notes payable is always at the face value of the note. Always. Notice there's no interest in that journal entry until time passes. At the end of the year, we have to do our financial statements, so then we have to recognize the interest expense that has accrued. And the interest expense is going to be principal $1,000, times rate, 10%, times time, which in this case is 2 months over 12 months. It's for November and December. Then down at payment, 3 months later, the interest expense is the last final month of January. Okay, and we get rid of the note payable by debiting. Remember, note payable is always at face. Then we have interest expense and interest payable because we have to get rid of this interest payable from the accrual, and then cash. Statements. This really does come from Accounting 1. The balance sheet shows the financial position of the company at a point in time. The income statement shows the results of results of operations over a period of time. If expenses are greater than revenues, we have a net loss. If revenues are greater than expenses, we have a net income. The accounting equation, which also comes from Accounting 1, is assets equal liabilities plus equity. But remember, in any equation, we can rearrange terms. And so in international standards or European standards, a lot of times they'll say assets minus liabilities equals equity. So be prepared for that equation to be restated on the exam. Also, if we have two of the numbers, we can calculate the third. So if assets are 1,000 and liabilities are 800, then we know equity is 200. Some more from Accounting 1. You have to be able to identify accounts as assets, liability, or equity. You also must know the normal balances and also what increases the account. So for cash, that's an asset. Its normal balance is a debit, so it is increased with a debit. If you see the word received, you know you're going to debit cash. If you see the word paid, you're going to credit cash. And on account means at some point you're going to do something with either accounts payable or accounts receivable. So that might help you in the test to not get confused. More from Accounting 1. Adjustments. So when you look at these adjustments, what is the result if fixed assets are not adjusted? We'll go to the journal entry. How do we adjust fixed assets, right? We have depreciation expense, yes, and we have a credit to accumulated depreciation. Okay, so what happens if we don't make that journal entry? Expenses are understated on the income statement and assets are going to be overstated on the balance sheet. What about current assets? Maybe that's prepaid insurance. I can do it this way. So we need to adjust prepaid insurance. So we are going to debit insurance expense and credit prepaid insurance. If we don't do that, then your expenses are understated and your assets are overstated. Remember, in an adjusting entry, you're always going to affect one income statement and one balance sheet account. How about accrued liabilities? What if they are not adjusted? That is actually wages expense, right? So an accrued liability is wages payable. And so what if we don't make this journal entry? Expenses are still going to be understated, but liabilities are going to be understated as well. Okay, so go to the journal entry, what would that be? And then from there, figure out what happens if that journal entry is not made. There's a few questions like that on the test. Inventory. In a perpetual method, you are always keeping track of your inventory balance. So when you purchase, you debit inventory and credit accounts payable. At a sale, right, you are going to debit cost of goods sold and credit inventory. Okay, so that would be at the sale. Okay, in a periodic method, you're going to debit purchases and credit accounts payable, and you're not going to make any journal entry when you sell inventory. Then you have to go down, you have to count the inventory to find out what's on the shelf, so that you can take your beginning inventory plus your purchases, which you've journalized, gives you goods available. Subtract off that ending inventory, and now you do have cost of goods sold. You also must be able to do a very simple inventory valuation problem using FIFO or LIFO. Okay, so they will give you the beginning balance, they will give you purchases, they will give you the ending balance, and you need to give the dollar value then of cost of goods sold, or I think you might give the dollar value of the ending inventory. But it is simple. It's not a super complicated problem, but be able to do that. The conceptual framework, there's a few questions dealing with accrual accounting. So remember, in accrual accounting, we recognize revenues when they're earned, and we recognize expenses when they're incurred. It doesn't matter when cash changes hands. In the matching principle, we are matching revenues earned with expenses incurred to earn those revenues. Warranties are an example of the matching principle. So we recognize warranty expense when we sell the asset or when we sell the refrigerator, right? Not when we fix it. Okay. I'm going quickly. I only have 15 minutes, so I'm watching the timer click down on me. Depreciation. We do depreciation because of matching, so we want to take the cost of the asset and match it against the revenues that it earns. The double declining method of depreciation, which you do have to do on the test, is the book value of the asset times 1 over the life times 2. Okay, and that gives you your depreciation expense. The straight line method gives you the same depreciation every period for the life of the asset. The book value of an asset is cost minus accumulated depreciation. So in year 1, if you're using the double declining method, the book value is just the asset cost. And so all of this ties together. To get the gain or loss on the sale of an asset, you're going to compare the book value, which is cost minus accumulated depreciation, to the cash received. If the book value is more than the cash, you have a loss. If the book value is less than the cash received, you're going to have a gain. So you have to be able to do that on the exam, figure the gain or loss. You also have to be able to do the double declining method. So you've got to be able to calculate book value on the exam. 3 slides left and about 3 minutes. So we have bonds. Remember, don't get confused at this 102. Okay, on the exam you're going to have a problem like this, and it's going to ask you what is the interest expense at the first interest payment. So first you have to get the selling price of the bond, and 102, 103, 104, that just means 102% of face. So I take 102% times $1,000, and that's my cash received down here. Okay, and bonds payable, like notes payable, is always at face. So then the difference, is either a premium or a discount, depending if the cash received is more or less than the face value. So in this case, we have a premium. To figure the interest, you have to amortize that premium, and it's going to affect the interest expense. So you have to take that premium, divide it over the life. So I took the premium in this case, divided by 5 years, gives me $4 per year, semi-annual payments, so I'm going to divide it by 2. The cash paid is coupon, which is 10% times 1,000, which is $100, semi-annual, so I have to divide it in half, which is 50. Then the interest expense is a plug figure. Okay, that's only one question on the exam though. So corporations, there's some theory questions there. Advantages of a corporation, it's easy to raise capital, limited liability for owners. Remember, in stock, I'm going to run out of time here. Run in stock, you have authorized shares, issued shares, and outstanding shares. Okay, you have to be able to calculate dividends and share them between preferred shareholders and common shareholders. And then remember, stock dividends do not affect total equity, only moving from retained earnings into common stock. So total equity stays the same in a stock dividend. All right, 30 seconds for statement of cash flows. Remember, the activities are cash flows from operations, investments, and financing. And the statement of cash flows is going to show you the change in the cash account from the beginning to the ending and explain that. If you have any questions, please send me an email on any of these topics and I can further explain them. Thanks and good luck.